Stop bleeding money. 10 trading mistakes you must avoid. Are you tired of watching your trading account dwindle? Do you feel like you're constantly making the wrong moves? This video will reveal the 10 most common trading mistakes that beginners and struggling traders make, and how to avoid them. Let's turn those losses into lessons and start building a profitable trading strategy. Imagine setting sail without a map or compass. That's exactly what trading without a plan is like. You're entering the market blindly, hoping for the best, but likely heading for disaster. Trading without a defined strategy means you lack clear entry and exit points. You're essentially guessing when to buy and sell, which is a recipe for losses. Without a plan, you also lack adequate risk management protocols. You don't know how much you're willing to risk on each trade, leading to potentially devastating losses. Finally, trading without a plan means you have no clear financial goals. You don't know what you're trying to achieve, making it impossible to measure your success or adjust your strategy. Risk management is the cornerstone of successful trading. Ignoring it is like building a house on sand. It might look good at first, but it won't last. Neglecting to protect your capital adequately can lead to the rapid depletion of your trading account. One bad trade can wipe out weeks or even months of profits. A good rule of thumb is to adhere to the 1 to 2% risk rule per trade. This means risking no more than 1 to 2% of your total capital on any single trade. This helps to protect your capital and allows you to weather the inevitable losing streaks. Emotions are the enemy of rational decision-making in trading. Succumbing to fear and greed can lead to impulsive and ultimately unprofitable trades. Fear can cause you to exit a winning trade too early, missing out on potential profits. Greed can cause you to hold on to a losing trade for too long, hoping it will turn around, only to see your losses mount. The solution is to stick to a predefined strategy and avoid making decisions based on emotions. Develop a system and follow it consistently, regardless of how you feel. Stop-loss orders are your safety net in the volatile world of trading. Failing to use them is like walking a tightrope without a net. One wrong step, and you're in trouble. Not using stop-loss orders leaves you vulnerable to significant financial setbacks. A sudden market crash or unexpected news event can wipe out your entire account if you're not protected. Stop-losses are essential tools for risk limitation. They automatically close your position when the price reaches a predetermined level, limiting your potential losses. Overtrading is a common mistake, especially among new traders. It's the urge to be constantly in the market, chasing every potential opportunity. Engaging in excessive trading activity can lead to emotional exhaustion. You're constantly monitoring the market, making decisions under pressure, and experiencing the highs and lows of winning and losing trades. Overtrading also increases your potential for losses. The more you trade, the more opportunities you have to make mistakes. The solution is to prioritize quality trades over quantity. Focus on finding high-probability setups that align with your strategy, rather than trying to trade every blip in the market. Trading without research is essentially gambling. You're relying on luck rather than skill and knowledge. Ignoring market research and analysis means you're making decisions based on hunches or gut feelings, which is a surefire way to lose money in the long run. Technical analysis involves studying price charts and using technical indicators to identify potential trading opportunities. This can help you understand market trends and predict future price movements. Fundamental analysis involves researching the underlying assets you're trading, such as company financials or economic data. This can help you make informed decisions about the long-term value of an asset. FOMO, or the fear of missing out, can be a powerful and destructive force in trading. It can lead you to make impulsive decisions that you later regret. Chasing the market means entering a trade after the price has already moved significantly, driven by the fear of missing out on potential gains. This often results in buying high and selling low. Instead of chasing the market, wait for proper setups before entering trades. Be patient and disciplined, and only trade when the odds are in your favor. Patience is a virtue, especially in trading. Rushing into trades or expecting instant results is a recipe for disaster. Profits often require time to materialize. The market doesn't always move in a straight line, and it can take time for your trades to develop and reach your profit targets. Stick to your trading plan and allow your trades sufficient time to develop. Don't panic and exit a trade prematurely just because it's not immediately profitable. Maintain a long-term vision and focus on building a consistent track record of profitable trades. Don't get discouraged by short-term losses, and remember that trading is a marathon, not a sprint. The trend is your friend, as the saying goes. Trading against the prevailing market direction is like swimming upstream. It's difficult and exhausting. Ignoring market trends increases your risk of losses. If the market is trending upwards, you're more likely to be successful buying than selling. Conversely, if the market is trending downwards, you're more likely to be successful selling than buying. Trade with market momentum and look for opportunities to enter trades in the direction of the trend. This will increase your chances of success and reduce your risk of losses. Every trade, whether winning or losing, is a learning opportunity. Failing to analyze and adapt based on previous trading experiences prevents improvement and perpetuates mistakes. Not learning from past trades means you're doomed to repeat the same errors over and over again. You'll never develop a consistent and profitable trading strategy if you don't learn from your mistakes. Keep a trading journal to track and analyze your trading performance. Record your entry and exit points, your reasons for entering the trade, and your emotions during the trade. Review your trading journal regularly to identify patterns and areas for improvement. Learn from your mistakes and adjust your strategy accordingly. Avoiding these 10 common trading mistakes will significantly improve your chances of success in the market. By developing a disciplined and strategic approach, you can protect your investments and build a profitable trading career. Remember, trading is a journey, not a destination. It takes time, effort, and dedication to become a successful trader. But by learning from your mistakes and continuously improving your skills, you can achieve your financial goals. Ready to take your trading to the next level? Subscribe to our channel for more educational content and trading strategies. Also, download our free trading checklist in the description below to help you avoid these common mistakes and start trading with confidence. Leave a comment below and let us know which of these mistakes you've made and what you're doing to overcome them. Let's build a community of successful traders together.